Good afternoon, everyone. Happy New Year and welcome to our first webinar of 2022 about tools for mitigating import duty, the latest in a series of webinars about trading in uncertain times, which we began last year. My name is William Barnes-Graham, the Senior Content Editor at the Institute of Export and International Trade, and I will be your host for the next 45 minutes or so. Next slide, please. So we're going to begin today's webinar with a poll to understand a little bit more about you, our audience. So I'm just going to launch that poll now. So as many of you will hopefully know, new rules were introduced for imports into Britain from the EU on New Year's Day. We are here looking to gauge to what extent you've been impacted by this so far, albeit it's still quite early on in the year. While you are answering that, just a couple of housekeeping notes. Firstly, you can contact me with any comments or questions using the question panel on the control window to the right-hand side of your screen. We hope to get to a number of your questions towards the end of the webinar, though please bear in mind we have already received a lot of questions in advance, so we'll not be able to get to all of your queries today. If you feel as though your question has not been answered, please do review our technical helpline or training and consultancy offerings, which we'll be talking about later in the webinar. And a tip on questions, if your questions are easy for me to understand, I'm more likely to ask them, so please do try to keep them concise and clear. Secondly, you will receive access to today's slide pack and a recording of the webinar in a follow-up email we will be sending over the next day or so. So please do try to listen in as carefully to today's presentation as you can read back the slides at a later time. So I will give you just a few more seconds to answer that poll. Thank you everyone who's answered so far, really interesting results coming through. And I will now share the results. So 14% of you are significantly impacted and 24% of you have been more minimally impacted. So about 40% of people responding to the poll have had some sort of form of impact. About 40% as well have not been impacted at all, but half of those are expecting to be impacted at some point. A quarter of you have said it's too early to tell, or is that you're not sure whether you will be impacted by the new rules. So thank you everyone for answering. Really interesting to see the response there. If we move on to the next slide, please. As you'll see on the next slide, it is my delight to be joined today by Amy Maltman, the Deputy to the Director of the Institute's Academy, and we'll be joined later on by Suzanne Alakrim for the Q&A. Suzanne is a customs consultant at the Institute. But Amy, first of all, it's early on in the year, but a really interesting response to that poll, about 40% impacted, 40% not impacted, and a quarter saying it's too early to tell in terms of the impact of new rules. Is that a surprise to you, that response?
Good morning, good afternoon, everyone, and welcome, Happy New Year. Thank you, Will. The response isn't a surprise. I guess at this point there have been so many changes throughout the entire year last year and into January this year, and I guess for the fact that there's a quarter of individuals who don't know how they're impacted yet, that's a little surprising to me. I guess it's difficult to keep on top of the legislation, so totally understandable, but I would strongly advise that you can read the advice and the guidance on the government website, and of course our daily bulletins and news reports that we send out should keep you in the know. I think it's really important that companies know what the changes are so that they can make sure that their businesses are compliant.
Thanks, Amy. Really good advice. And if you're not already following our daily update, then please do look on export.org.uk for more information. But a lot to get through today, beginning on the next slide. So over to you, Amy, to say a little bit more about this webinar and the series that it's a part of. Over to you.
Thanks, Will, and welcome everyone. Hopefully you'll find this useful. So just to kind of give you an overview of today's session and why we're completing sessions on uncertain times. So, you know, we're trying to help businesses who are trading in uncertain times, and those uncertain times can be dictated by various different factors. And uncertainty really is not a nice place for businesses to be. So we're providing an enhanced support for businesses in the form of real-time news alerts. We have an enhanced telephone helpline, which is available for our business members. And we also have a live web chat function on our website, which is actually those are manned by customs consultants. It's not a bot. And we also have, as you're joining today, an expanded range of webinars. We also have one-day training course around helping businesses plan for uncertainty, and a new package focused on managing trade and change and risk, all of which can occur at any point. Okay, so hopefully that helps set the scene in terms of why we are launching these webinars and what we're looking to achieve. And in today's webinar, we're going to look at duty mitigation. Okay, so from the beginning of the year last year, duty has been payable on goods entering the UK from the EU and vice versa. And it's payable when goods move across international borders, and specifically when goods move into a country from another country. So the amount of duty payable depends on lots of different factors. Firstly, the commodity code. Secondly, the customs value of the goods. And lastly, the origin. And we've hosted loads of webinars on these topics since January last year, which are available for our members. And we also do training courses and consultancy packages if there are businesses out there who are struggling to come to terms with what these are and how to quantify. So customs duty is paid as a percentage of the value of the landed cost of the goods. So that means that the cost has to be built up, okay? And it's built up of various different things, delivery costs and various other factors. And the percentage payable depends on the commodity code. And a common misconception is that customs duty is not paid on free of charge or replacement goods, and that's incorrect. Customs duty is payable on free of charge goods, and I would strongly recommend that you have a look at Customs Notice 252. I would also strongly recommend getting an idea of commissions, royalties, license fees, services, tools, engineering, drawings, artwork. All of those elements should be included in the cost of the goods for duty purposes. Okay, so it's not, you can't make an assumption that the invoice value should be declared to customs. There could be other elements that need to be included. So recommendation, first of all, would be to understand your duty exposure. And we've talked about how customs value and the commodity code determines the amount of duty that you would pay. So each country has its own tariff schedule, and that applies to goods coming from third countries. And one of the key principles underpinning the World Trade Organization is to encourage trade without discrimination. And that means that signatories of the World Trade Organization cannot discriminate against other signatories, meaning that they have to apply the same duty rates to goods coming from all partner countries, and that's called the most favoured nation principle. And MFN rates would be payable on goods where there is no free trade agreement, or where the goods don't qualify under the free trade agreement, or where there's no other kind of trade suspensions or unilateral trade reductions available. Okay, so in the UK, the MFN schedule is known as the UK Global Tariff. And when the UK introduced the global tariff at the start of last year, they reduced and eliminated duty on a lot of products. And that means that the same goods going into other countries may attract duty, but may not in the UK. Okay, and I think that's important context to understand duty exposure, because your duty exposure might be different for goods moving into various countries. And just to make you aware, the WTO, the World Trade Organization, also has a database of MFN rates for WTO members, and that's called the WTO Download Tool. And it's a comprehensive database of import duty rates into all WTO member countries, and can be downloaded into Microsoft Excel. So that can be quite good if you're trying to understand what duty exposure might be into a third country. So first step for a business would be to evaluate their duty exposure before they understand whether duty mitigation is even necessary. So firstly, identify the commodity code for your goods, okay? And then identify the origin of your goods. and then identify the customs valuation. And remember, Notice 252 will give you more information on that. Check the UK global tariff for the duty rate if the goods are entering the UK or Great Britain, and complete the calculation to understand what the tariff exposure is. Decide whether you need to consider duty mitigation and investigate what the options would be. And it would surprise you the number of people who actually don't stop to evaluate duty exposure before they jump into duty mitigation. It could be that the duty exposure is actually minimal, and it could be that the VAT is the more or the higher kind of value. In that case, there are other options, but duty mitigation is purely looking at whether first of all quantifying the duty exposure, and then looking at the different options, which we'll talk about today. So there's various reliefs available in the UK, and the three main things to consider when you evaluate whether relief's available and what type of relief you might look at is where the goods will come from, what will happen to the goods while they're here in the UK if you're a UK importer. Will they be stored? Will they remain the same? Will they be changed or processed into a different product? What will actually happen to those goods while they're here? And then lastly, where will the goods end up? Will they stay in the UK or will they be exported? Okay, so I would always start with those three main questions. And in the next slide, we'll discuss custom special procedures. But some of those custom special procedures may require prior authorization from HMRC. Some can be used on a one-off basis, just by your declaration being accepted at the border, but some do require prior authorization from HMRC. So if we take inward processing, at a high level allows imported raw materials or semi-manufactured goods to be processed and then re-exported. And it's a tool to enable national enterprises to offer their products at a competitive price, and therefore that promotes economic growth and helps to provide more employment opportunities in the UK. So we'll look at an example in the next slide. Just a couple of kind of words of warning. So it can only be used where the goods are being processed and is not suitable for storage. And when the goods enter the UK, the import duty is suspended and discharged if the goods are then re-exported or moved to a different customs procedure, such as customs warehousing, or released to free circulation. And if the goods remain in the UK, they can still actually benefit from relief using inward processing if the final product attracts a lower or nil rate of duty than the imported products. Okay, so you need to ask yourself that question. If the final product attracts a lower or nil rate of duty, there still could be relief available if your goods are staying in the UK. Okay, so we'll look at an example of inward processing. So we have goods that move from Spain to Great Britain. In other words, it's a Great British import. So the import duty would be suspended when the goods arrive in Great Britain. And the raw material would be used in manufacture of a finished product in Great Britain. And whilst that happens, the import duty remains suspended. And then the goods are the finished product that had been manufactured are re-exported to France. Okay, and when the import duty, the liability would then be released by virtue of an export declaration being created, showing the goods moving from Great Britain to France. And it's so important that the import declaration and the export declaration are completed correctly. Okay. And last but not least, and probably the most important stage, is the bill of discharge, as it's known, which is basically a return to HMRC indicating what has happened to the goods that were suspended, where the duty had been suspended. Okay. So inward processing is for processing. Customs warehousing is for storage. Okay. There is the ability to complete what's known as minimal processing of goods, which is basically to allow the goods to be maintained. So customs warehousing is also known as bonded warehousing, and it's similar to inward processing, but different in that it allows storage of goods. So in the same way, the import duty remains suspended. And there's two types of customs warehouse. There's a public warehouse, and that's where you might have a business like a freight forwarder who would store goods belonging to other companies and other individuals. And then you would have a private warehouse, and that's where businesses apply for their own customs warehouse and they store their own goods in that warehouse. Okay, and in the same way, we'll look at another example. So we have goods that move from Poland to Great Britain. The raw material or finished items can be either shipped from the supplier in Poland into Great Britain, and when the goods enter the customs warehouse, the import duty is suspended and remains suspended while the goods are in the warehouse. So they're held, there's no processing, no fundamental changes made to the goods, and then they're shipped back out to Germany. Okay, so goods are exported from Great Britain to Germany, and again, the import duty liability is released by virtue of the fact that there's been an export declaration to release that liability. Now, there is a variation to this. You know, you could have goods that are stored in a customs warehouse in the UK that are then sold on to another UK customer, and that UK customer could bring those goods into their inward process and authorization before they then make the re-export. There's many variations of how these processes can work and how the customs special procedures can work in conjunction with each other. Okay. So outward processing is slightly different because it allows goods manufactured in Great Britain to be processed or repaired in a third country before they're then returned back to Great Britain, and that's with partial or full relief from customs duty on the return. So it allows national enterprises to reduce their production costs, and that therefore makes products available at a more competitive price. So the import duty would still be payable on the charges for the repair or the replacement, plus the shipping and insurance for the actual goods movement to return the goods. It's incumbent upon the outward processing authorised party to correctly calculate the amount of duty. Okay. So another example, probably less common, you can get relief on certain goods that you import from outside the UK if they're going to be used for a specific purpose. So it applies to certain goods, things like civil aircraft and parts, shipwork goods, military equipment, that type of thing. And you can check whether authorised use is available for your goods on the UK global tariff. Okay, there will be an indication that authorised use is available. And then lastly, temporary admission. So having temporary admission allows the authorisation holder to import goods and hold them for 2 years before you re-export them. So there's different levels of relief available for eligible goods, and then there's partial relief available for goods that are not on that eligible list. And there's also different timings depending on the type of goods as well. But goods that are placed under temporary admission are not intended to undergo any change except normal depreciation. So temporary admission is useful where the goods will be stored in the same form with no changes for a period up to 2 years. So it might be good for samples and professional equipment, goods that are going to go on undergo testing, that type of thing. So just a word of warning. So all of the customs special procedures require the importer to track the goods from import through to export and provide proof that the duty liability has been discharged. And that comes with a heavy administrative burden and compliance requirement. So depending on the size and the complexity and the processes and the systems that a company might have, that could be more difficult for some than others. So compliance is key and it's not an option. And HMRC will hold businesses accountable for correct reporting of goods movements. So I can't emphasise enough how important it is for the authorisation holder to check accuracy of what's being declared to HMRC and make sure that they're in control of those goods movements and that they have full visibility of where their goods move to and from. Okay, so that was kind of a quick run through of customs special procedures, but there is another relief available, and that's called return goods relief, RGR. Slightly different in that it's not a customs special procedure. and it doesn't require prior authorization from HMRC to use it. The way that you would be authorised to use it would be acceptance of your import declaration, indicating by using the customs procedure code for return goods relief. Okay, so it allows relief from import duty on goods that were exported from Great Britain that were in free circulation where the duty had been paid, that are then subsequently returned. Okay, so it's slightly different from outward processing, as the goods can't have been changed or upgraded to increase their value while they were outside of Great Britain. They have to be the same goods that are where the relief is applied on return. So conditions apply. The goods must be re-imported in an unaltered state, apart from general maintenance or preservation. The goods can't have been upgraded to increase their value. Apologies, I think my screen has frozen slightly. Yeah. They must have been in free circulation in the UK when they were exported. So the duty must have been paid on all of the parts within the final product, and they cannot have been exported for repair or processing. Okay. And the goods must be returned within 3 years. So it's really important that the importer has evidence when they claim the relief on return that the goods were in free circulation when they left and therefore are eligible for return goods relief. Again, I've just got another example to run through. I think it's good to do this just to show you visually how it works. So we've got a product manufactured by an engineering company in Great Britain, and the goods are in free circulation and they're shipped to a customer in Spain, held in a warehouse, no alteration made to them, and then are returned back to the manufacturer in Great Britain within 3 months. I should say 3 years, apologies. So it is possible to claim return goods relief as long as the importer here has evidence of this original export, and HMRC do allow alternative evidence. It doesn't need to be the export declaration. They will allow any evidence that shows that the goods were in free circulation when they left. Okay, so it can be very useful for companies, definitely worth considering. Just as well to mention before we move on, it's very important that the importer here only claims VAT relief on the import if they were the same company that exported the goods. Okay, otherwise import VAT should be still payable. Okay, and then just another slide to add here. In any situation, there's room for human error or miscommunication, and that means that there's always a possibility of an error resulting in either an over or underpayment to HMRC in duty. And HMRC recognises that and expects importers to have sufficient processes in place to identify, correct and remediate the likelihood of future occurrences of any errors. But they also have a process to apply for a refund if you've overpaid duty, or make an application to pay any underpaid duty back. Okay, so depends on how your import declaration was processed. If it's done on CDS, they're still accepting a CDS form for an underpayment to be made, an overpayment reclaim, and if the import declaration was done on Chief, you can now apply using the government gateway, but just be prepared to supply copies of the import paperwork, commercial and transport paperwork, your calculations to show why the duty payment was incorrect, and your contact details and bank account details as well. I think it's useful to know about. And then just lastly, before I hand back to Will, we do have a team of experts on hand to help with any support that you might need. If you're unsure whether duty mitigation is necessary or what type of relief would be available, please do not hesitate to contact us. We have consultancy packages where we can help customers understand what duty mitigation might be available for them and what opportunities there could be. We help customers make applications for custom special procedures and maintain those authorizations once you've been successful. And we offer 2-hour trade surgeries on any international trade topic. So it could be you book a 2-hour trade surgery just to have a chat through with one of our consultants to see what options could be of use. And we also make general recommendations for improvement for your business. So contact training@export.org.uk if you would like any further information on any of that. And with that, Will, I'll hand back to you. Thanks for listening.
Thanks, Amy. A lot of really useful information there. So thank you for guiding us through all of those different tools, reliefs, procedures in such a short space of time. I know they can be quite complex. As you can see here, we're going to do another poll. This is following on from the first poll. Actually, it's a similar theme. It's just asking whether you have a plan in place for new customs rules for EU to GB imports. Yes, no, but planning to, or no and not planning to. Just while you're answering that, we'll start to head into the questions, and delighted to be joined as well for this part by Suzanne. Hi, Suzanne.
I will.
First
Nice
question.
to be here.
Great to have you. A webinar debut, I think it is, in terms of this program anyway, so welcome aboard. Suzanne, one thing we haven't touched on in today's presentation is probably the most obvious trade duty mitigation tool, which is free trade agreements and other preferential tariff systems like the Generalized System of Preferences, or GSP. I appreciate that we have actually covered this in a lot of our other webinars and training courses, but could you say a little bit about how traders could make use of arrangements like put my teeth back in, could make use of arrangements like trade deals?
Yes, certainly. So we have mentioned the WTO most favoured nation principle, how this determines how duty applies in the absence of a free trade agreement or the UK's generalised system of preferences. Where there is a free trade agreement or economic partnership in place, it's important that importers have evidence that the goods are eligible for preferential treatment and that they meet the criteria of the agreement, in which case a nil or lower rate of duty may apply. Remember as well that each agreement is negotiated on its own terms and not to make the assumption that all agreements mean duty-free. Therefore, please check the trade agreement with the country you're trading with and make sure that you understand how to comply with the requirements to benefit yourselves and your supply chain. The UK also has a unilateral trade preference for goods coming from developing nations such as Nigeria or Vietnam. And where GSP is available, as long as evidence has been supplied that the goods qualify, which is now a GSP Form A, completed by the exporter in the country, and an origin declaration on the invoice, then the UK importer can utilise this to reduce the duty rate for goods coming from those developing nations. We have covered trade agreements on our other webinars and training courses, so please do check our resource library if you would like more information on this topic.
Thank you, Suzanne. And we do actually have a webinar on the 17th of January, which will be talking about where we can ask more questions basically about trade deals. So yeah, please do look out for that one. I'm just going to close the poll to share the results. Thank you everyone for answering. As ever, this is really interesting. So 62% of you do have a plan in place, 25% of you don't yet, but are planning to, 13% of you don't, but are not planning to. Amy, that's given our audience generally has been to a lot of webinars about just this topic. Is that a surprise? That's probably about the level I'd be expecting. What do you think?
62 have a plan in place. That's really encouraging. I'm slightly worried about the others, and we can help, so please don't panic. But I guess we've got to a point where we're now a year in, Will, and companies are there's probably a little bit of Brexit fatigue or post-transition fatigue, which I fully understand. But I think that some of the rules that have come in are quite significant, especially for companies who import from the EU into Great Britain. So I would recommend it can be daunting, but please do have a look at the government website to understand what those rules are, and reach out if you need help with putting the plan in place.
Indeed, and as noted earlier, do have a look at export.org.uk for news stories and updates about the new rules. I mean, it's interesting. Our audience generally have been in a lot of these webinars, so we've been raising awareness about these rules, but it's interesting to think what the response would be at a broader business event.
Yeah.
So thank you everyone for answering that poll. And on the next slide, you'll see that we're now firmly into the Q&A. So Amy, just to bring it back to custom special procedures, are there any scenarios where you could claim a customs special procedure at the same time as making use of the preferential tariffs in a trade deal?
That's a really good question. Well, so when you're importing, the importer has a choice as to whether they want to claim preferential origin or if they want to apply the most favoured nation duty rate that we talked about under the UK global tariff. So if the importer claims preferential rate, then the goods are automatically in free circulation. They've no need to, you can't apply the MFN rate. If the MFN rate's zero, there's no need to apply preferential origin. The interesting thing is when you're exporting goods to a country under preferential origin, within most free trade agreements, there's what's known as a no drawback clause, and that means that the goods cannot have been processed under customs special procedures and also benefit from tariff-free access to the third country or the other country. And that would prevent then an exporter being able to issue an evidence of preferential origin if they've processed those goods under a customs special procedure. So always check the terms of the individual free trade agreement. Just an important note though, within the UK and EU trade and cooperation agreement, there currently is no drawback clause, and that means it's possible to have both situations, and that will be reviewed in due course by both the EU and the UK. So that could change in the future, but it's definitely important for traders to know about that at this point.
And just staying on special procedures and release, are there any scenarios where a company may be choosing between special procedures, or are you only ever likely to have one that's applicable to your business?
I think, again, it's a good question because, as I said, there's three main factors to consider when you're choosing what relief might be available, where the goods come from, what will happen to them, and where they'll go to. So each custom special procedure has been designed to fit those different scenarios. So it's highly unlikely that there would be a scenario where there would be multiple options to choose from. It could be for different goods, there's multiple options. So companies would just need to consider, and I think preparation is key, having visibility of where your goods are coming from, what exactly is happening to them, where they'll go to, and being educated about that in advance so that you can prepare for any scenario that might happen in the future.
And to bring in Suzanne, just in terms of procedures Amy's been mentioning, what considerations should businesses be making in relation to how procedures may affect other actors within your supply chain?
So that's a really important point. So within the supply chain, there could be multiple partners who can make duty mitigation more difficult, especially if you are operating a global supply chain. It's important that companies work with their supply chain partners and they ensure that they have visibility of the entire end-to-end goods movement. It's important to pass goods under customs special procedures to other authorization holders. For example, a manufacturing company in the UK, just because your customer is based in the UK, it doesn't mean duty mitigation is off the table. They might be storing the finished goods and distributing them back out of the UK, in which case, if they had a customs warehousing authorization, duty mitigation is still achievable. It's also important to review the Incoterms being used to ensure they are suitable for all supply chain partners and reflect the actual situation taking place, and that the partners also write them into the contracts of sale. This is so that all parties understand who is responsible for what, where the risk transfers, so that all parties' interests are protected under law. I think the key is supply chain traceability and working closely with the suppliers and customers to ensure that you achieve the optimal saving for your situation.
Thanks, Suzanne. I think that's really important. That's a point that's come up on a number of webinars, is kind of that visibility for the supply chain in terms of who's responsible for what, but also how different uses of procedures and so on have that knock-on effect. It's really important. But it's actually, you brought up Incoterms, so I'm just going to now dive into some of your own questions for users, so for delegates. And we had one in from Karen, who was asking, actually around Incoterms. So she said, could you cover just generally interpreting rules of origin to benefit from preferential duty rates for use of Incoterms in a transaction, and also facilities like deferment accounts? So quite a big question, Suzanne, but do you want us to cover those three areas briefly?
Yes, that is quite a big question. I don't think we've really got enough time to cover all of that in detail today, but please do consider signing up as a member of the Institute of Export and International Trade. We have covered these topics, as we've mentioned, in our lunchtime learning webinar series since January 2021 and on different webinars. They've all been recorded, and recordings are available for our members in the members areas of our website. We also do one-day training courses and consultancy, so we can dig deeper with customers and traders to understand their needs and then help them and guide them on the specific topics. So yes, unfortunately, not enough time to cover it today because it is such a big topic.
Yeah, it was a bit of a cursed question, that. So yeah, hopefully there's some useful information on the site there, Karen. So let's look up through the questions now. So this is a really good one from Sarah, who talks about her company having the Percy pig issue. So this would be for you, Amy, if you may. Sarah's company imports a product from the Netherlands into the UK, but they do not significantly alter the product, so cannot declare it as of being UK origin. So when selling this product back to the EU, our customers have to pay duty on the import. What should Sarah's company do?
Yeah, that's the classic Percy pig problem that arose kind of after the free trade agreement was signed, and then we began interpreting the legislation within the agreement and realised that there was actually quite a problem here for UK distributors. So it's difficult to give a complete answer without having all of the facts, but in general, you can't issue evidence that the goods are eligible for preferential origin in that situation, as the goods don't meet the rules under the Trade and Cooperation Agreement. But your customer in the EU might be able to use return goods relief. So we talked about it today. As long as the conditions outlined in the EU's RGR have been met, so the conditions are very similar to the UK's in that the goods need to have been returned in an unaltered state within a particular time frame, and you need to have evidence that the goods were in free circulation when they left the EU to start with. And remember, just VAT relief should not be claimed if the EU exporter and the EU importer are not one and the same. And there could be other scenarios that apply, things like outward processing. But again, it's very difficult to advise without knowing exactly what's happening to the goods while they're in the UK. Hopefully that's helpful though.
I hope so, and to be honest, Sarah, if you do have follow-up questions to that, then we do offer quite a lot of technical helpline services, but also consultancy offerings around the use of procedures and just these sorts of scenarios.
Exactly.
Another question has come in from Luke, which I think is a goodie. So we've talked largely about kind of orthodox import duties, but there's also other duties in terms of anti-dumping duty, anti-dumping tariffs and quotas. So Luke's asked, can we reclaim duties for goods in scope of an anti-dumping tariff? Amy?
Yeah, it's a good question. Probably back to the same three questions, which is where the goods are coming from, what happens to them, and where they'll end up. But it depends kind of whether there's processing that takes place. So you can actually mitigate anti-dumping duty using inward processing. So the goods are entered in inward processing, are then processed and disposed of in one of the correct ways in terms of re-export. So that could be an option depending on what's happening to the goods. And there's actually another option now within the UK's anti-dumping rules that once you've paid anti-dumping duty on goods, if you can show that the products imported were not dumped as such, or that the margin of the dumping was less than that on which the measures were based, you can actually claim a repayment of that. So really important to refer to notice 376 for anti-dumping duty advice, and it will give you the different scenarios available.
Thanks, Amy. So that's notice 376, and then you'll be able to find that on gov.uk.
Absolutely.
Just actually a quick note to say that a couple of the links Amy mentioned in the presentation earlier, I've put into the chat. So that includes the UK trade tariff tool and also the WTO download facility. So do have a look in the chat for those, and we can add those to the PDF of the slides, which we'll be sending to all delegates after today's webinar. We've got time for a few more questions. So this is one from Terry, who's asked, can I use inward processing without having to apply to HMRC for an authorization? Amy, do you want to tackle that one?
That, again, another great question. I'm actually quite pleased that one's been asked. So we do, HMRC actually do allow retrospective applications for inward processing, so after the fact, and then some custom special procedures like inward processing also allows the importer to use what's called authorization by declaration, and that does not require prior authorization from HMRC, and authorization would be given at the time that the import declaration is accepted at the border, so it can only be used, I think it's 3 times in a rolling year, so it's not suitable for regular use, but it's good for traders who might have one-off scenarios where they want to claim inward processing. There's more information on the government website. I can include the link in the chat. If you just go on to government website and input inward processing, then the legislation and the notice will pop up, and hopefully you'll find the information is quite clear.
Thanks, Amy. I've got time for a few more questions. One from Caroline. Let's put this to you, Suzanne. Caroline's asked, could you advise the reasons why it is important to state the market value of your goods on your commercial invoices when using special customs procedures, and what are the risks involved if you do not?
Yes, so this is something that Amy has already looked at and mentioned that there is a prescribed process to arrive at the customs value for your goods, even when you're using custom special procedures. There are full details published in the HMRC Notice 252, and this shows you how you can build up your price, including other things such as discounts and commission, as well as your profit and the cost of the goods. The risk associated with failing to build up the price correctly, if this gets identified at import, it could be a customs compliance failure, and it may result in penalties, and it may even result in customs special procedure authorizations being revoked by HMRC if they think that you are repeatedly, incorrectly calculating your prices.
Thanks, Suzanne. That was Notice 252, just for anyone who didn't catch that. We've got time for 2 more questions, I'm going to say. So one in from Monica, which I think is really interesting. So she's asking about ways of easing the significant admin burden of applying for customs relief, for example, return goods relief. She has large volumes, but with a customs value of each being around £10, the admin seems as though it's more expensive than the cost of absorbing the extra duty. I mean, that's kind of really getting at the commercial decision in terms of the effort of using a customs procedure versus a potential duty saving. What advice would you give in that to kind of companies of lower value imports, Amy?
I think that's a really good question. As I said at the beginning, it's really important to evaluate what the duty exposure is, and that there has to be a cost benefit analysis exercise completed. You know, what's the benefit of you implementing a mitigation tool like a custom special procedure or return goods relief versus the cost, because sometimes the implementation of the actual procedure itself and all of the processes and admin can outweigh the relief for the benefit. So it's really important that a company does that exercise and takes those, starts off with the evaluation and then looks at whether remediation is even necessary. In the scenario where there's low value components, there could be low value relief available as well. So investigate what exactly there is available, and it could be that you have a conversation with HMRC to say, is there evidence? Would you accept just an invoice to show that these goods have been returned? And then in the situation where there's return goods relief, there mightn't be as much of an administrative burden, so that might pay off. Have that discussion with your HMRC officer or office, whoever that might be, and they might be able to offer you advice.
Thanks, Amy. We'll do one last question, and it's around origin, because I think we've only touched on it today, but it's so important as a topic. So James has asked, do we need to ask for the origin of goods from our EU suppliers for each product we're importing? His firm is purchasing interior products from Sweden. Sounds about right. Suzanne, do you want to just quickly touch on then the kind of origin requirements companies need to be wary of?
Yes, so on the rules of origin, then you need to be checking with your suppliers and getting that evidence. So when you import, you will see it on your invoice. That's the declaration that you can present to customs. But also, if you're importing from outside of Europe, you may need to be looking at what trade deals are available and what origin evidence is written into those trade deals. So, for example, you may require a certificate of origin, or customs again may be happy with that declaration on the invoice. So again, just checking with your suppliers to make sure that you can evidence that origin, and then when you present it to customs with your tariff code, then that duty rate will be applied at import. So yes.
Sorry, Suzanne, just to add to that, what you might find as well. So if it's not preferential origin and you're buying from the EU, it's important that you ask the supplier the origin of the goods, because if they've bought them from a third country, for example, China, when you bring them, they haven't changed the origin. When you bring them into the UK, there could be anti-dumping duty payable on them. That's why it's so important to have that, traceability and visibility, because HMRC will hold the UK importer responsible. So have that conversation with your supplier if there is a concern that the goods have originated in a different country other than the EU.
Thanks, Amy. Thanks, Suzanne. It's a huge topic, origin. We did a couple of webinars at the end of last year. Obviously, we've been touching more on imports in this particular session, but we also, I think, we covered origin requirements for UK to EU exports as well in one of our lunchtime learnings from memory.
Yeah.
So please do look on the site for access to those resources on origin, and it's a topic we'll keep on coming back to because it's just such an important topic for companies to get right. But we have sadly run out of time for any more questions. These webinars are supposed to be shorter. They're supposed to be half an hour, and we end up prolonging them to about 45 minutes. So I'm going to have to wrap up now. Thank you once again to Amy and Suzanne for the presentation and answers today. Really interesting stuff, and we hope you found it useful. And thank you as well, our audience, for so many fantastic questions. Before we go, just a reminder that today's webinar has been delivered as part of our Trading in Uncertain Times suite of enhanced support, helping traders to continue trading despite Brexit rule changes, global supply chain issues, and ongoing geopolitical tensions. As Amy mentioned earlier, this suite includes real-time news alerts, an enhanced telephone helpline for our business members, a new live web chat function, which is being answered by real people, a new one-day training course and consultancy, and more webinars just like this one. For more information, please do visit export.org.uk/trading_in_uncertain_times. We'll send that link in the follow-up email, through which you will also get a recording of today's webinar and the PDF of the slide pack. For now, though, thank you for tuning in, and please do let us know what you thought of today's webinar in the exit survey. Thank you, everyone.
Thanks, everyone. Bye.